All right, we're getting into a really confusing year in real estate. And if you're a buyer, seller, homeowner, investor, or even a renter, or someone who's thinking about buying but maybe are unsure, this video is for you. I'm going to go over strategies, what to do, what not to do, and how to prepare for this year and the next coming years. So, of course, my name is Ryan Taylor. I'm a licensed realtor here in the province of New Brunswick with Royal LePage Atlantic. The opinions in this video are my own. They do not reflect the other opinions of members of my company or other realtors in the province of New Brunswick or elsewhere. Now, let's start with buyers. What do you do in this year? Well, the first piece of advice I'll give you is, yes, the window is really beginning to open. However, don't rush to catch a falling knife. You're going to hear a lot of different rhetoric in this industry and outside of the industry about what you should and shouldn't do. You're going to hear things like, you're only going to know when the prices are at the bottom when they start to go up. And though technically that can be true, it's often not always the case. So the best course of action is to figure out, should you buy now? What price point are you comfortable with? What is your risk tolerance? And how do you want to go about it? You're not trying to time the bottom. You're just trying to time what the best point for you to enter the market is. Now, the window is just opened. This is not a window that's been opened that is going to close soon. This is not a market where the inventory is falling off a cliff like 2021 or 22. This is a market where the inventory has been rising and the sales have been declining and the market is beginning to get quite stale. Real estate operates in cycles. It goes from buyer's market to a shift market to a balanced market to a shift market to a seller's market and so on. There is no data at this time that leads me to believe that this window is going to close anytime soon. So there is really not much urgency. I will say, however, if we see the prices not increase from January to February, it'll be the first time that I've ever seen this happen. Now, that does not mean that the window is going to shrink sooner. It just means that the window is going to open wider sooner. So this is the beginning, not the end of an opportunity to buy. Just make sure what you buy at the right price and you buy something that's right for you. Now, the months of inventory is an interesting statistic. So it is how long it would take to sell every listing on MLS if no new listings came on the market. It is basically an indicator of the pace of sales versus the current standing of inventory. When people think of a buyer's market, oftentimes they say the MOI north of 6. I am not of the opinion that the MOI is a good indicator of what type of market you're in. However, it's a great indicator of what is and isn't selling, how stale the inventory is, and where the market might be heading. Now, generally, when MOI gets high, above 5, above 6, it tends to lead to stagnating prices, or at the very least, prices that don't rise. I looked at the data over the last 10 years in Moncton and New Brunswick. There's really not a lot of correlation there between the median price and the MOI. However, if you look outside of the area in places like Toronto, you're going to often see a sort of a trend where high MOI or rising MOI leads to flat or declining prices. So the number one thing you should do is a cost versus rent analysis. Find out what your total costs are going to be for buying the home and what your total costs are going to be for renting. Run that data, figure out what makes more sense financially, and then go from there. Even though the buying market is softening up, the rental market is softening up even more. So your good rental deal might actually make more sense. It just depends on what you're trying to do and what your long-term goals are. Next would be figuring out what your risk tolerance is. Every house has a different risk profile to it, and it's very important to know or shop with someone who understands what age a building is, even if it's not listed, how to identify that, and what sort of risks come with that. There's a lot of difference in risk between a 1990 home, a 2010 home, a 1970 home, and so on. Every decade has its own unique risk to it. Now, the last two pieces of advice for buyers: buy a good home at a good price that suits you. Buy something that you are able to commit to for at least 3 to 5 years, preferably 5 to 7 years, and make sure whatever you buy, it fits your risk profile. Ideally, buy with someone who knows what they're talking about and isn't just opening the door for you. Now for sellers, this is a very, very confusing time. Some of you already have realtors. Some of you are interviewing realtors. Some of you are on your second or third realtor. And I am here to tell you, as a realtor who would, of course, love the opportunity to have a listing, there's a good chance that the reason your house is not selling is not actually because of your realtor. The first thing a realtor should do is try to figure out and eliminate the possible causes why the listing is not selling. So making sure that it's getting lots of exposure, the right type of exposure, good marketing, good photos, good ads, etc., and then go from there. Oftentimes, the number one reason a house doesn't sell is price. And even though the data might have indicated that the price made sense when you listed it, that could change, especially in a declining market. So pricing it correctly is obviously very important. However, sometimes that's hard to do. So what do you do if your price is not correct? Well, when you list a home, one of three things is going to happen. Either someone's going to come in and write an offer right away. That's how you know you're priced well. The second thing is you're going to get a lot of foot traffic, a lot of showings, but no offers. That means you're close, but not close enough to get that offer. And then the third thing is nobody looks at the house at all. Now, obviously, even in this market, there's initial momentum after the first 2 weeks. But if you're 2 months in and you haven't had a showing since your first 2 weeks, you're priced at least 5 to 10% too high. And of course, a last piece of advice for sellers would be don't chase the market, set the market. If you need to sell and it's not an option to sit on it until the market heats up again, make sure that your price is going to set the market. Don't constantly be trying to react to new listings hitting the market, because as we get later into the year, there's going to be more inventory. Now, what to do as a builder? This is a market where inventory is getting stale, especially in the higher price points. It's getting much more difficult to sell things. So you're going to have to pull out some stops, perhaps appliance deals, perhaps landscaping, paved driveway, internet deals. You're going to have to get a little bit creative on how to increase your value proposition. I definitely recommend having an interior designer come in, quote out how much it would cost to stage. You could do the AI staging, but I don't love that. And really, you have to look at your business at this point as a way to get custom build customers. Your spec home business right now is not really about selling your spec homes. It's about getting clients into the pipeline to build custom. And it's going to feel a little weird at first, but essentially what you're doing is you're trying to set up a model home. You want to impress these buyers, because even though the market will probably slow down and the sales might fall off, if you can get a nice steady stream of clients who come to you because they like what you build and they want you to build for them, that's going to be a much more reliable business than trying to build a spec home and hoping you find the right buyer for it. So try to make that pivot this year. It's very important that you do. Now, how do you impress buyers? You're a builder, so you probably already know how to do this. If you're just getting into building or you want to start getting into building, number one thing, don't cheap out. Make sure that the pantries have rollouts. Make sure that you're not cheaping out on the cabinets. Make sure that the paint is good. Make sure your trim is good. Little things matter. They add up. Don't go cheaping out on the mini splits, on the waterproofing. Make sure it's nice. Now, for commercial, I don't do a lot of commercial. In fact, I don't really do any commercial. And if I did, I would have to bring on an expert with me. So my advice for commercial real estate investors is to find a guy on Twitter or X. It's the strip mall guy. Strip mall real estate is not attractive. It is kind of boring, but generally what you're looking for is tenants like banks, Starbucks, Second Cup, those sort of things. Nothing flashy, but just something that's reliable. You don't want to be buying Class A real estate rented out to a bunch of startups. Sure, it might look good initially on a portfolio, but it's going to have more of a risk profile to it than something boring and safe like a strip mall with a bank. Now, for commercial, there are definitely a few offices. You have your Colliers, you have your Cushman & Wakefield. I don't know enough about this industry to suggest a lot of it. Just when you do choose a commercial real estate specialist, make sure you choose someone that is specifically knowledgeable about what you're trying to do. It's entirely possible that someone knows a lot about retail, might not know anything about industrial. So make sure you find that right fit. Personal anecdote, I will say, I find a lot of the Class A commercial real estate in the province of New Brunswick, specifically Moncton, is a little bit overrated. A lot of it is literally just Class B with a little bit of a facelift. So I would not balk at Class B, even though the vacancy rates are higher. And I would definitely not run to Class A unless you're getting a good deal on it. I don't think it's worth paying up for Class A real estate most of the time in the commercial field in Moncton. All right, now onto multifamily. So multifamily is very tricky right now. We are in a rising vacancy area, and we are starting to see a lot of these developers and landlords starting to get a little bit worried on why they're not renting out these units. And I'll put it very simply, this is probably not going to change. The pipeline for immigration has more or less been stopped entirely, and people can't really afford the rents here. So you're going to have to get creative and competitive. Now, what does this mean? Obviously, there are certain buildings that I think have good value propositions and probably are going to be totally fine. But you have to understand what your best competition is and then tailor it towards that. Specific categories I'm a little bit cautious about right now are people who bought old buildings and then jacked up the rent so much that they're almost the same price as a brand new building. I would definitely avoid that. And if you are someone who owns multifamily residential real estate, If you can sell that for under a 6% cap rate to another buyer, I would just do that. And if you're looking to buy multifamily, keep in mind, I get paid a lot of money if I sell multifamily. Those are typically big properties with big checks. So I'm here to tell you, probably don't buy right now. See what happens over the next 4 to 6 months at the very least, because the more this rental market softens, the more we're going to start to see things like receivership and insolvencies begin to creep up. Really, you want to wait for that to become more of a buyer's market. I really don't like to come up with specific cap rates that I think are good targets, but I don't think personally I would buy anything under a 7 cap in Moncton, and anything over 7 cap is usually hard to find, but pretty good. You could settle on a 6.5, but I just think the risk at 6.5 is not worth it in this environment. Wait and see what happens. They're continuing to build more and more, and the vacancy is rising higher and higher. This is a very high risk category, in my opinion, and I think it's one that should be treated as such, and I don't think it's worth settling on a 6.5% cap rate. Now, for homeowners with renewals coming up, you have probably heard all kinds of stuff ad nauseum over the last 2 years about how rates are only going to go down and real estate prices are only going to go up. That is not always the case, as you probably know by now, and it's definitely important to stay in touch with your mortgage specialist on a regular basis to make sure you're in the loop on what's happening in the economy. If you're on a variable rate, you should have that conversation right away, because the Bank of Canada is unlikely, according to banks, to be cutting rates potentially this year. There are actually 3 banks that are predicting rate hikes, and all the other ones are not predicting anything besides staying flat. My personal opinion, I do think the economy is beginning to soften quite a bit. I do think that the Bank of Canada will probably at some point this year be forced to cut rates. However, I do not think this is going to spur housing activity, and I don't think it's going to increase the prices. Just like how rate cuts did not increase the prices in the 1990s Toronto real estate crash. It took a long time for those prices to come up, and the rate cuts did not do enough. It's important to understand that the bank cuts rates not to stimulate real estate, but to stimulate the economy and incentivize people to borrow more money and spend more money in that economy. And that did not happen last year, and it's tough to say what's going to happen this year. But if you're able to get a good price on your variable rate, do so. Now, fixed rates. These are different. Fixed rates follow the Canada 5-year bonds if you're going with the 5-year fixed rate. And these are generally the safer product to go with. And it is important to understand how that bond yield works. And by that, I mean, nobody really can explain this to you in a way that's going to make sense. But there is very little Canada can do domestically to influence their own bond yields. Typically, the Canada 5-year bond is at the mercy of the U.S. bonds. So look at the U.S. Treasury bills and then look at the Canada bonds. We follow those pretty closely. And of course, your fixed rate is based off the Canada 5-year bond. So keep that in mind. You don't have to understand a lot about economics. It's a very complicated subject, especially when you talk about bonds. But the way it works, the more people buy bonds, the lower the yield gets. The price and the yield are inversely related. So more people buy the bonds, the price of the bond goes up, the yield goes down. Less people buying bonds means the price of the bond goes down and then the yield goes up. It's a little bit complicated, but basically what you have to know is if you see a 5-year fixed rate at something that you find comfortable, you should strongly consider settling for it. I don't think it is worth the risk to try and save even 1% on your mortgage payment at the risk of it potentially going higher. One thing that's happened in the bond market is that hedge funds are trading at a higher level than they were in the past, and it's definitely more volatile than it's been. Now, for renters, this rental market is soft. You have options. Maybe it doesn't feel like it, but you do. In the lower price points, it's going to be a little bit more sticky, but you still do probably have some options. Identify if you're actually getting a good deal on your rental. If you are, try not to play with fire because there are not a lot of good rental deals out there, even in a soft market. However, if you feel you're not getting a good deal, or maybe your landlord is an absentee landlord who doesn't do anything to maintain the property, aka a slumlord, then strongly consider some of these new buildings. They're having a hard time renting out, at least some of them, and I'm sure that they would be open to a tenant with good payment history, even if it feels like it might be out of reach. Now, of course, I have to say this again, all the opinions in this video are my own. I am a licensed realtor with Royal LePage Atlantic here in Moncton, independently owned and operated. And please find me on Spotify and YouTube. I am the New Brunswick Real Estate Podcast on Spotify and on YouTube. And you can also find me on Facebook and Instagram, New Brunswick Real Estate. Thank you very much. If you have any questions, leave me a comment. Thank you again for everyone leaving reviews. And I look forward to putting more content out. Thanks a lot.